This morning, mortgage rates dropped, and every headline out there is going to tell you that this is great news for the housing market. Well, I hate to be that guy, but I'm here to tell you the truth instead. This dip is just a fake. It's a fugazi. The people that actually set your interest rates believe that they're going to stay high in 7, and some analysts are predicting 2028. 2 weeks ago, that really would have surprised me, but not anymore, and I want to show you why. Hey guys, I am Paul Messina. I go by the Mortgage Vet Paul on social media. I'm with Milestone Mortgage Solutions. I'm a mortgage advisor and a VA loan expert. Every Monday, well, this week it's going to be Tuesday, we go through what the financial news from last week actually means to you. Not the headlines, but the real truth, the structure of it all, the things that people don't tell you. And we're going to do a deep dive into this to really help you give you some more understanding. So let's not waste any more time. Let's get into this. If you felt jerked around by interest rates and mortgage news the past few weeks, you're not insane. Here's the thread that's driving it all. It's not inflation. It's not our economy. It's oil. Of course, oil is all a part of that. But what I'm getting at is it's not the issues at home that are affecting us. It is hundreds of miles, thousands of miles overseas. So last week, rates dipped a little bit, and then the conflict with Iran got worse. The Strait of Hormuz was shut down again. Oil was not flowing. The world got scared. That one channel where a lot of the world's oil comes through is all bottled up. Oil prices shot up, topping $100 a barrel again. That made gas prices go up over $4 a gallon nationwide average. Here in Montana, we're about $4.40 a gallon for regular, and we're in the fives for premium. So high performance sports cars, guys, congratulations. This is inflation. So that's what the Fed is trying to fight. That's what the prime rate does. It's an inflation regulatory product. It helps us curb inflation and make things more affordable in home. Here's what is most people are never told. Your mortgage rate doesn't follow the Fed interest rate. We've talked about this numerous times. It follows the 10-year treasury rate, and that's the rate that the whole market watches. When it goes up, your mortgage goes up behind it. It is a direct correlation, not an inverse relationship. They don't move opposite, they move together. Last week, that 10-year rate hit 4.71. That is the highest since January of 2024. The mortgage rates followed, ticking up to about 6.6%. And when we talk about average rates, we're always talking 30-year fixed conventional with a bunch of different assumptions. But short and sweet is it's based on the 30-year fixed interest rate for a conventional loan, not VA, not FHA, not a combination. And I'm not the only one that's saying this. So the chief operating officer of Mortgage News Daily, he said the same thing. He pointed straight at the fuel prices as the main driver of the spike and made the point that rates were already just sitting at that very high threshold. This additional information and all this back and forth between Israel and the United States and Iran, that just pushed things over the edge. But what I wanted to get at is, and reinstill, is that none of this came from the housing market or other economic indicators. All of this was driven by oil in a place thousands of miles away. Just let that sink in. Now, here's what happened this past weekend. Things turned around. Late last Friday, the U.S. and Iran pulled back. Nothing was signed. Peace talks had started again. Both sides paused their airstrikes. Iran was open to having a dialogue over the strait and opening it up, allowing oil to flow. And since that time, things have still been easing. The 10-year spiked to 4.71 last Thursday, but at the time of filming earlier today, we were at 4.62, and at the close of the market, we're at 4.60. That's the third straight day that we've ticked down lower, and all of it on oil prices backing off and the conflict seeming like it's easing. The same lesson as 2 weeks ago, just flipped. Your numbers didn't move on the job numbers or home sales or other housing indicators. It moved because of the oil tankers halfway around the world. Here is the part that I really need you to understand. This morning's drop, and at close of market right now at 4.607, this is just temporary relief. It's a Band-Aid, guys. It is not indicative of true recovery. That oil threat has not gone away. It is simply on pause, and you cannot build a solid, reliable financial plan on a pause. We need to plan for the worst, hope for the best. Let that sit with you for a few minutes. So where does that leave us today? Well, Freddie Mac's weekly numbers say we're at 6.58, but that's a rear view mirror, right? It's already data that's been collected earlier in the week, so it's days old by the time it hits the headlines and hits the numbers. What a lender's actually going to quote you for a conventional rate right now, honestly, your rates are up in the high sixes, 6.75, 6.875. That's what we call the par rate, where it's not going to cost you any discount points. You might even be in the sevens, depending on your credit profile. That is absolutely an honest and candid read. There's no fluff, yes, but I'm not an AI bot. The rates just keep climbing in wake of this war fear. And this week, they're trying to come back down on the wings in the hopes of peace. But here's the one critical component for this week that's different than any other. Wednesday is the Fed meeting. the Fed will have the final word as to what happens to your interest rate in the next 7, 10, 14, maybe even the next 90 days. Now, tomorrow, the Fed meeting, as I record this announcement, is tomorrow afternoon. Most are expecting that rates will hold, but this is one of the most split Fed meetings in years as far as speculation. So, guys, if you're on call sheet, I'm telling you, take the information I'm about to give you, invest it wisely, and you might see a return of a couple $100 just on this one component if it's available. Some traders are betting on a rate cut, others think they will hike. I am on the side of the hike. One Wall Street firm expects a hike just to prove that the new chair is serious about curbing inflation. Nobody agrees on this. Kevin Warsh has said he's going to stop telling people what's coming up next. He's not Jerome Powell. He's going to get out to the podium, give the answers, give the rationale, and then he keeps his mouth closed. Politics aside, it doesn't matter whether you liked Powell or not. My opinion is that Powell is the reason why we're in the situation that we're in right now, because we added some easing back in October of last year to try to curb inflation, but it never let off. It had the opposite result. We actually increased inflation because we kept it in longer than was expected and longer than was necessary. So even a hold announcement could jolt your rates depending on what he says afterwards on the commentary. Thankfully, up to this point, Warsh has been a kind of behind the scenes guy. Comes out, does his job, says what needs to be said, and then off he goes into that yonder. What's the point here? No one at the Fed is signaling that you're going to see any kind of relief, let alone 5%. Where are people getting this ridiculous 5% fantasy rate from? Now, let's answer a question that everybody's asking. When are rates actually going to come back down? Well, I'm not going to give you any kind of BS, guys. Here's the honest answer. It's not going to be what you want to hear. Two of the biggest names in the mortgage industry, Fannie Mae and the Mortgage Bankers Association, MBA, of which I'm a member, have just updated their forecasts. Fannie Mae says plan on the 30-year conventional rate sitting around 6.3% through the end of 2027. 2027. I think that's 7, right, guys? 6.5% is what the MBA is predicting, and they're saying it's going to go all the way through the end of 2028. Now, these are the people that fund the mortgage market. None of them see a 5 in front of your interest rate at no cost for years to come. We can't even get people to 5% right now on a qualified conventional loan with discount points because the tolerances won't prohibit it. It's so far off. Here's the second thing that nobody's explaining to you. AI and tech, and it's not affecting it in the way you think. Actually, people are getting very nervous behind these giant tech companies who have borrowed huge amounts of money, hundreds of millions, some even billions of dollars to build their AI systems and build these data centers. And we've seen the result here in Montana. 2 or 3 of the most recent ones that I know about that we're trying to push through, they've all been denied by local planning commissions. Everybody's concerned about the environmental impact. That is causing the confidence in that industry to start to wobble a little bit. And this is when lenders and investors in the markets get really, really about that kind of debt. High interest, high amounts, lots of potential for economic instability, lots of potential for the government to have to step in and maybe do some bailouts of some major companies if it goes wrong. So what do they do to ease that tension? They charge everybody more to prepare for the worst, right? This includes you and on your homes. On the oil side, that's affecting us in one spot, and we're getting the 1-2 punch from the tech industry at the same time. And you can see what it's doing already. It's not as evident or as overt as it may be in the next 6 to 12 months. But we absolutely know that this is a contributing factor affecting buyer affordability. And that's caused buyer affordability to now slip for the 5th month in a row. On the flip side, new construction, builder confidence has turned negative, and it's been that way for the past 15 straight months. We're going on almost a year and a half. That is the longest stretch 2012. And this is not just a blip on your financial radar. This is the market that everybody is operating in today and for the foreseeable future. So here's the plain truth. Stop waiting for your fantasy 5% interest rate, guys. It's not going to happen. The people who move this market, who fund this market, are telling you this is not happening. Buy a house that works with your budget today. Lock that payment in at what you can afford before things get worse. If rates dip later on, then you refinance. I hate this expression, but it holds true. You marry the home and date your interest rate. The average home buyer sits on a home loan for about 3.3 years, regardless of whether or not they stay in the home. Stop sitting on the sidelines. Stop costing yourself money for a number that experts say is not coming anywhere in the near term. That means the next 2 to 5 years. Do you want your $2,000 a month, $24,000 a year building wealth in somebody else's pocket? Or would you rather take the plunge and help that build wealth and secure your own financial future? So let's take a pause, guys. We're going to pull this out of Washington. Let's get into our own backyards because the national stories are not necessarily your local market decision points. And here's something that backs this up. One of the most respected analysts in the housing industry called the market this week as being balanced. So what does balance mean? Balance means neither buyers nor sellers have an advantage. This is a huge shift. In North Carolina, one of the states I do a lot of business in, the June statewide median purchase price was $382,500. They estimate that market inventory statewide is at 5.8 to 6 months. That is officially a balanced market. I just had a conversation with an agent 10 minutes ago before I started recording this who told me, Paul, things are going really slow. I don't want you to think I'm not trying to send people your way and get people into homes. I have no business. I was booming this point last year. So what does that mean? It gives you guys room to negotiate right now on a level playing field in that state. And that's in spite of, prices. And this is all fresh information. Now, military people, Fort Bragg, Camp Lejeune, they just posted. The median purchase price has increased to $399. That's up about 2% from a year ago. Roughly about 2 months of supply in the Fayetteville Fort Bragg area. It's still moving, but giving buyers a lot more room than this year. Sorry guys. It's still but giving buyers a lot more room than they had last year. On to Montana, my current home state. Cascade County, Lewis and Clark counties, Flathead and Missoula counties. I leave Gallatin County and Yellowstone County out of the mix because they're always the outliers. We're running around 3.5 months supply. That's roughly 2,000 homes active in the MLS nation or statewide. So we're a little bit tighter than North Carolina, and things are going to move a little bit faster. Prices, 280 to 350 in Great Falls, Montana, Malmstrom Air Force Base region. Decent homes are under contract in 24 hours or less. Here's how this connects back to Wednesday's meeting. If you find yourself in a position where you are presently under contract and evaluating your loan options or wondering whether or not you should be locking, give me a call. Let's take a look at your scenario. There might be a way to save you a little bit more money. I might be able to give you a little bit more of a strategy on whether or not you should have your rate floated versus locking your rate, and maybe things will turn around. But I wouldn't do anything till the Fed meets and gives their decision. So either we lock now on the sure thing, or we take that gamble and wait for the Fed decision and see what markets do. And then we might have to actually wait a few days to see things cool down after the announcement. If you're out there searching right now, this is the time to get pre-approved. Know what your numbers look like in the here and now. And if at all possible, and you can lock and shop, do that 100% so that you don't find yourself in an unaffordable payment situation for the dream home that you find weeks from now. Instead of scrambling when the rates are jumping around, planning is key. You can never have your pre-approval or affordability conversation too early in the process. On to the Veterans Corner. So here's a quick update on something we've been tracking in a couple newsletters and past few broadcasts that we've done for the Monday Mortgage Minute. The VA funding bill is still moving through the Senate, but it's tucked inside a bigger housing package. Nothing has passed yet. But let's recap what happens if it does. Your VA one-time VA Streamline Refinance, the EARLs, it's going to jump from 0.5% to 1.42%. That's nearly 3 times the amount. So on a $300,000 loan, your funding fee, if you're not exempt, is going to go from $1,500 to over $4,000. That's absolutely insane. Loan assumptions, that funding fee is going to double as well. In case we need a recap, loan assumptions where you have a really low interest rate on a VA loan. Somebody comes in and the servicer and the VA approves, they can take your loan at that interest rate, but then they pay you the difference between what's owed and what your sale price is as far as the down payment goes. Buying a home with your VA benefit, that's not going to change. That funding fee is expected to stay the same. So your zero down purchase is safe. I will tell you when and if that becomes an issue. Until then, if you're sitting on a potential refi situation, have these conversations with your mortgage advisor now. This is a conversation that you need to have while the fees are still low, and then ask them, put them on the spot. Tell them, I want to know what this costs me if that bill passes and it goes up to what it's expected to go up to. All right, guys. So here's our full week recap in one breath. Oil rates are up. This week gave you a little bit of relief as far as rates in the 10-year Treasury bond. The Fed has a decision tomorrow, but the bigger story has already been written. Higher rates for longer periods. Let's say that again. Higher rates for longer periods. And here's what you need to take away from all this. You cannot control oil prices. You cannot control the conflict in Iran. You can't control the Fed decision. And you cannot control a wavering tech market. But you can stop waiting for a number that the experts telling you is not going to come anytime soon. 6% interest rates are not the enemy. Waiting on the sidelines while rent prices keep climbing, home prices keep climbing, homes keep appreciating at the national average rate of 3.2% or higher, that is going to cost you in the long run. If the payment works for your budget today, if the home you want is there, lock it in, date your interest rate, come up with a plan with a mortgage advisor who will be with you for the duration, not just for your closing. If 5% ever shows up again, we refinance and celebrate. Do not build your life around a rescue scenario when the people who fund this market are telling you this is not coming. So let's have a conversation, get your numbers. The links are below. I am Paul Messina, the Mortgage Vet Paul on social media. Go get after it. I will see you Wednesday. I'm going to do a brief update, let everybody know on a reel on social media what the Fed said and what it means. And I will see you on the other side of that decision.